It's February 21st, and I want to talk about how are federally backed student loans different from other loan products in the market, forgiveness opportunities, as well as payment reduction opportunities coming down the pike for those with student loan debt, the good news for parent plus loan borrowers, okay? It's February 21st, and I want to talk about, of course, the news updates, because I always do that, but I want to address how are federally backed student loans different from other loan products in the market and why that matters for all the different news that's coming down the pike, as well as forgiveness opportunities, as well as payment reduction opportunities coming down the pike for those with student loan debt. And I want to start with how are student loans different, because it makes the federal student loan programs and their adjustments very different than on any other loan product out in the market. So I want to give a little educational context before I dive into the news. And then, of course, I also want to talk about the good news for parent plus loan borrowers, okay? We've had a lot of different parents engage with us, ask questions across our channel as well as in our company. Again, if you do not know me, I'm Catalina. I am the CEO and co-founder of LoanSense. We give a completely free plan through our software at myloansense.com if you want to check that out. The majority of you who are watching are not subscribed. If you like content like this, please do consider liking and subscribing so that we can produce more content, okay? Okay, so let me dive in. First and foremost, before I go into the news, how are student loans different than any other mortgage product in the market? Not mortgage product, I'm sorry, different than any other loan product. So with loans, this is why in the United States we have what's called a credit score. Your credit score is supposed to indicate your credit worthiness. And as a result, if you have better credit, you get a better interest rate, right? So if you're deemed to be more credit worthy, if you're deemed to have a debt to income, which is enough, make enough money to pay your debts, and you have a reasonable debt to income level, then lenders view you as lower risk, the lower amount of debt you already have, and therefore you're a better borrower to potentially lend money to, right? So better credit score, lower debt to income, and having a history, of course, as part of your credit score, a history of making on-time payments, paying obligations to other lenders, as well as not having a history of bankruptcy or not having a history of not paying your debt back. So that is determined by your credit score. The better your credit score, the less debt you have, the better of a borrower that you are in the eyes of a lending institution. The better of a borrower you are, the better interest rates you're going to get. Of course, with other products, banks, how it works is they either take deposits and use some of that money to lend out, or they can also borrow against the government, like the U.S. Treasury. So that interest rate matters. And so let's say the federal interest rate is 2%. They will add margin to give themselves profit between what they can get money from the feds and other banks for. They'll add margin so they can make money off of the loan they provide to you. They assess the risk. Some people will default, not pay them back. Others will pay them back. And based on the risk profile that you have and your likelihood that they deem you as a default risk, they will give you an interest rate for that specific product. Of course, the longer the loan stretches out, the more risk, because you can lose your job and various other factors. So depending on the loan product, that will also determine the interest rate. Okay, that's how a normal loan product works. How does a mortgage loan product work? And one other thing, lenders across different products have different debt to income requirements, different credit score requirements, different payback requirements, and they all get to determine what those requirements are. Mortgage is a little different because it's often set by the mortgage regulators, which will have standard debt to income requirements, and the mortgage market interest rate is also much, much more regulated because of who buys these mortgages on the secondary market. This is what makes mortgages slightly different. But it still considers the risk profile of you as a borrower in order to give you a mortgage loan. So how are student loans different? Student loans are different because when the federal government lends out a federal student loan, they are not looking at the risk profile of a borrower. You're 18 years old, you may have no credit, you have never paid back a loan, they will lend you money anyhow, right? The interest rates are high, right? Right now, interest rates, Congress sets interest rate every year. So unlike a bank-backed loan product, the government sets the interest rate. That's a huge difference. And they do not consider the risk profile. So for example, if you get a liberal arts degree versus an engineering degree versus a medical degree, the government does not view the likelihood you'll be able to find gainful employment and pay back that loan into the risk profile of you as a borrower at all. They just say Congress sets interest rate. We treat everybody the same. If you come from a low income household, we will give you a subsidized loan as long as you go to a reputable higher education institution that has shown to have a low default rate with student loans. They do assess the institution slightly based on a quote unquote cohort default rate of that institution, but they're not assessing the qualification of the borrower. Okay, so they're trying to figure out a formula to hold the higher ed institution accountable, but there's, in my opinion, not enough measures to hold them accountable, actually, because I believe that the risk profile of you as a borrower changes based on the type of degree, the institution, but none of that's taken into consideration. So now what the government is doing, because they considered a person getting a medical degree at a prestigious and a reputable school is the same risk as someone getting a film degree at a not so reputable institution that has lower earnings. I'm not trying to say anything about arts or film degrees, but they just have a lower earning potential, right? None of that's been considered. So that's how student loans are different. So of course, the government wants to make education accessible. So they want to say, we want to provide funding regardless of your degree, regardless. They want to make it accessible so that they can make education accessible regardless of what you're studying. So we understand the intent of the federal government, but as a result, what is happening is different people are defaulting and the default rate is projected to go up. And so now the government, with all these recent updates by Biden, is attempting to help borrowers who have gotten themselves into a pickle, okay? Because of the way lending works in the student loan world that's different from any other loan product, okay? So he's trying to broaden access to millions of borrowers by providing wider relief, and they're drafting regulations right now based on 17 indicators, okay, of forgiveness. One of the indicators is low income, right? If you have low income, you are less likely to be able to pay back your loan because you have low income. And that's what income-driven plans are for, and we already have that in place, okay? Then another indicator is having high debt or high expenses relative to income, right? He's going to now try to consider debt to income as an indicator. Another indicator is like demonstrated financial need. So if you come from a family with low financial means, let's say you come from a single household family and your mom doesn't earn very much money, you qualify for Pell Grants, or even let's say you qualify for federal benefits like Medicaid, SNAP, etc., right? Those are indicators of financial need, okay? Then there's, of course, hardship, like you become disabled, you get diagnosed with cancer, right? Those are hardship based on something outside of the previous factors. And then another indicator is based on student outcomes. So if you go to a horrible school that has low graduation rates, has horrible employment, that's another indicator. Again, there's a catch to that because I think they need to stop letting those institutions borrow, but stop letting those institutions get money to fund those degrees. That's my own personal opinion on the side. I think a lot of people would tend to agree with me. And then there's like a catch-all provision that allows the Secretary of Education to kind of determine based on the data that comes in of potential relief based on who is coming for what reasons. And that could be determined down the line, right? So he's instituting some negotiated rulemaking right now on how to determine the qualifications across the indicators I had just mentioned. And that is what's under negotiated rulemaking right now. When we have more clear understanding of what that looks like, I will, of course, update you as well. On another piece of news, Senate Majority Leader Chuck Schumer and Elizabeth Warren are urging the president to expand proposals for forgiveness, which is what he's trying to do. But, it's an election year this year, so it's really important that all these different government talking heads have their points made because they want to all get to reelected, right? So they are all chiming in, of course. And anyways, as a result, of course, what I just mentioned, the Secretary of Education, Biden, proposed these indicators to help borrowers get expanded access. And of course, what Elizabeth Warren and Chuck Schumer, Chris Holler, Bernie Sanders are saying, hey, we need to include Parent Plus borrowers. So this is where I talked at the beginning of the video. A lot of different measures often exclude parents because they're like, well, parents now, they're older, they're more financially savvy, they should know what they're doing. Well, apparently, if you tell a parent that their child can't qualify for money and that they have to take it out or they can't go to that school, parents feel guilty oftentimes, like, oh, I didn't save enough, or I got a divorce, I don't have good, whatever the circumstance at life, I lost my job, whatever it may be, and they don't have the funds, so they feel guilty, so they take out the money and now they can't afford to pay it back. And it's horrible. It's leading to our retirement crisis, in my opinion. But basically now these senators are saying we need to stand up for Parent Plus borrowers. So as the news comes down the pike on Parent Plus loans, I'm very empathetic to parents. There's a double consolidation loophole. I have a whole other video I will link on the double consolidation loophole. If you have issues, we've helped many parents do the double consolidation. Come to us. We're here on standby. Again, myloansense.com to get a completely free plan. Let us help you if you have questions, because the savings is always exponential compared to what we charge. And the professional advice, especially if you have 6 figures of debt or if you're a public service loan forgiveness candidate, you've lost your job, lost income, those are all great reasons to come to us. We help many people on a daily basis, and we cannot wait to help you, especially if you have any indicators that I just mentioned in this news update. Again, myloansense.com, and we cannot wait to help. Comment, like, subscribe, and we will talk to you soon.